Welcome to WakeCon, where we make sense of housing and community shaping economics. Powered by Professor Lending, I'm Jordan Steffaniak, president of Professor Lending, licensed loan originator and your home buying professor. And in today's episode, I'm going to be covering the topic of mortgage rates, what it's going to look like for 2026. So a lot of you are probably asking, will I be able to get a mortgage rate below 6%? Will I be able to see a 5 in the front? Well, some of you probably have already seen some 5s in the front. But let's go ahead and just sort of walk through a little bit of the economic shaping factors for how to think about mortgage rates and what to expect in 2026 and beyond. Now, disclaimer here, calling what rates will be, expecting what rates are going to be in the future is to some degree a fool's errand. We have some guardrails in place, so I don't think we're going to be at 8%. I don't think we're going to be at 4%. I can sort of say that really confidently, barring some major economic event and barring some crazy change at the Federal Reserve and some other economic events. I think we're in a pretty good range. So let's just sort of walk through what that range looks like, where we're at now. And there's a couple of things you need to understand where mortgage rates are going to be at. One of those is that you need to understand sort of how the Federal Reserve works, how the Fed funds rate works, how the 30-year fixed mortgage sort of tracks that. So a lot of people mistakenly misunderstand it, and they think the Federal Reserve somehow sets mortgage interest rates. They do not. The Federal Reserve sets a 24-hour short-term interest rate. That's it. They do not set the mortgage interest rates, which is a much longer period of term. Most of those trade at 5, 7, 10 years is what you're thinking. That's why most often, if you want to know where mortgage rates are at, the 30-year fixed, you're going to go look at the 10-year treasury yield. If that's going up, mortgage rates are probably going up. If that's going down, mortgage rates are probably going down. And there's a relationship there between these two sort of investments. Mortgages are traded as mortgage-backed securities in the market. They're seen as a little bit riskier than the 10-year treasury yield or a treasury bond. So bonds backed by the U.S. government, by a sovereign nation, are seen as zero risk. Mortgages have a little bit of a risk, which creates what's called a mortgage spread. So I'm just going to share with you guys a couple of things, and that way you'll be able to get a sense for what's going on. So here you'll see a simple chart over the last couple of years of mortgage spreads. This is the difference between the 30-year mortgage rate and the 10-year treasury yield. And you can see in 2023 that was much higher. 2024 is better. 2025 it's even better. The reason that's happening is because there's less risk in the housing market and in mortgage-backed securities. And so that number is shrinking. Now, the difference between these two things has historically been much smaller, but has grown a little bit since COVID. Now it's coming back smaller. So that's really important to understand because that can impact where mortgage rates are at. We can have zero change in economic policy, zero change in the Fed funds rate, zero change in any of these things, and yet have better mortgage rates because the spread gets better. So if that gets a little bit better, maybe we're at 6.5 right now, we can see 6.25, we can see 6 if spreads just get back down to historically normal. Now, another thing I want to mention here is the Fed funds rate versus a 30-year fixed mortgage. So you see this here with Fred, and you can see, generally speaking, it can track a little bit. So you can see over the last couple of months, over the last year and a half, we've been going down a little bit on the Fed funds rate. Mortgage rates really have been holding somewhat steady in comparison to that. So ideally, hopefully, we can see a little bit of more downward pressure on the 30-year fixed a little bit over time. This is important here. This is called the dot plot. This is where the governors of the Federal Reserve sort of come out here and say, okay, well, here's where we think interest rates are going to be at over the next couple of years. So you can see some downward pressure here. Right now, we're in this 3.5 to 3.75 window. You can see that where all those dots are. And there's dots slowly going down with the number of people where they think they're going to be at. So in 2026, we think maybe one more rate cut, get down to 3.25 to 3.5, and maybe make our way down a little bit. Tracks down a little bit more. You can maybe see some more downward pressure to where interest rates go. Right here, you see 6.25, 6.24. Maybe we can get down below 6 by the end of 2026. Now, I want to walk you through what that looks like, historically speaking, based on the 10-year treasury yield. So take a look here at this chart. This is the 10-year treasury yield over the last several years. So I've got this going back to pretty far back. You can go back to 1918. So see here, I just put a couple of lines. Historically speaking, with mortgage spreads at an average, 5% mortgage rates are about here when the 10-year treasury is like 280. 350. Obviously, we've been sitting up here quite a bit and we just ticked back up again. So if you want to see 6% mortgage rates, we really got to see some more downward pressure. I think we could probably see 6% or less at 380, 390. you can start seeing some of that based on credit profiles. If you have a really strong credit profile, you're going to be under 6 when the 10-year treasury yields at 390-ish. But on like a large scale average, we really need to get down here and then down to here to see 5%. So the realistic chance of seeing 5% in 2026, probably 0 or below 5%. I mean, I think you can see 5.9, 5.8, 7.5 even, I guess is maybe what you would be seeing as a potential rate for you in 2026. But I just can't see us getting below some of these, getting really far down. I mean, we haven't been that far down since 2023, almost got there in 2024. So realistically, my estimate for 2026 is hopefully we can see some downward pressure on 30-year fixed mortgage rate and 15-year fixed, all mortgage rates. But I don't foresee us seeing a huge plummeting. I don't think we're going to see this anytime soon. It doesn't matter what the White House says. You're not getting down there. I mean, that would be great. I'd love it. But realistically, I think you're going to see, at best case, 5.5% is the average. More realistically, I think you're still in the 6s, low 6s. But I think low 6s, the more people have that, the more the housing market can sort of turn and start going forward again. Anyway, that's my prediction. I would suggest probably 5.5 is the absolute floor. 6.5 to 6.75 might be the ceiling. So I think we're probably going to be in that range in 2026. That's my estimate. That's my guess. I could be totally wrong. It's always possible, freak things happen. But I think that's where we're gonna land in 2026. So let me know if you have any questions, thoughts. Hopefully that helps you think through what's next as you plan for what to buy or what to refinance or whatever that goal is. Maybe you need to pull the trigger now. Maybe you should stop waiting because you're wasting money or you're losing out on opportunity to grow equity to buy a house, whatever it is. If you have questions, feel free, reach out. I'd be happy to answer any questions. You can comment, you can send a direct message on social media, you can shoot us an email, text, whatever works. I'm pretty available for you guys. So I appreciate you for tuning in and look forward to talking to you guys soon.